welcome to this large corporate update following Jeremy Hunt's autumn statement on the 17th of November 2022 with myself, Chris Daines, and my colleague Chris Denning, both from MHA. Some interesting updates, no major surprises, but a few key points to talk you through. We're going to start with BEPs 2.0, which it was confirmed that they will be following the expected trajectory of implementing those rules that will be important for very large businesses from 2024. The main surprise there was that it will bring in £8 billion over the next 5 years, which I think actually there's some big questions there over those numbers that we wanted to touch on with you today.
Yeah, Chris, thanks for that. Yes, so the government had projected, I think it was 2.8 million a year of additional taxes as a consequence of bringing these rules in. The UK is probably the UK is one of the first countries to introduce these rules, and other countries will do the same. What was most interesting yesterday was we not only had the introduction or the confirmed introduction of the what's known as the income inclusion rule. The UK also announced the introduction of a minimum domestic top-up tax, which essentially means that if any UK profits are subject to an effective tax rate of less than 15% in relation to UK profits that could otherwise get taxed elsewhere under the rules, the UK Exchequer will now get that tax. So what you can conclude from that is that as other countries introduce these rules, they will be doing the same thing. So whether the UK actually generates the anticipated revenues from these measures remains to be seen, I think.
Yeah, totally agree. I think a lot of other countries will want that tax themselves rather than it going to the UK. So for me, a big question mark over whether that will actually bring in 8 billion for the UK over the next 5 years. R&D was the biggest surprise. The R&D credit regime for SMEs and large corporates has always been a great way to incentivize innovation, and innovation was something that Jeremy Hunt really majored on. But the tax rule change there really is encouraging innovation even more so in the large corporate area, but not so much in the SME sector, by stripping their support back by about a third. So I think there'll be a lot of SMEs that are driving a lot of innovation in this country that will be very unhappy off the back of the rules.
Yeah, I'd agree with that, Chris. I think there are two sides to this. I think my initial reaction was it was wholly counterproductive, certainly in terms of encouraging investment in the UK. But looking at the rules in a bit more detail, clearly there are two aspects to the rules. There's the R&D reduction in the benefit, but the RDEC increase. RDEC applies to larger companies. So to the extent that the RDEC changes enhance and increase or incentivize larger companies to invest in the UK, then that's great. On the SME side, though, the R&D regime applies to the SME sector. I think one of the reasons for the reduction was there's a feeling that the SME scheme is being abused somewhat. I'm not sure reducing the rate necessarily solves that problem. I think the abuse, if there is abuse, will just be done at a lower level. But the SME regime is a key element of the funding makeup of startup businesses, particularly in the tech and pharma sector, which are two sectors which are key to our innovation strategy. So for me at the moment, I think reducing the rate is not a particularly good measure in my view.
I agree. I think there'll be a lot of SME innovative businesses not being happy with what they heard yesterday. And please see our more detailed R&D video for more details on this important update. Next, windfall taxes. I think the increase from 25% to 35% for the energy profits levy was expected, but then also bringing in a 45% rate for the electricity generators was a little bit surprising and really kind of against the green agenda. I think if you're solar or wind farm producers that don't benefit from exemption against this rule, you'd be pretty unhappy. Equally, if you'd recently bought an electric vehicle and now having to pay some road tax from 2025. So I think they're not really being in line with the global trends towards ESG and greener behaviour. I think Jeremy Hunt may take some flack on that front. Lots of complexities to those windfall taxes, but at a high level, probably more of a vote winner than something that's going to really drive change where we need it.
Yeah, again, I'd agree with that, Chris. I think there was to some degree an inevitability, but certainly from a political perspective, I think Hunt had to be seen to be doing something, particularly off the back of recent profit announcements from BP and Shell. Albeit though, it needs to be borne in mind that those profits are global profits, not just profits from the UK oil and gas extraction from the UK continental shelf, which is the bit that the energy profits levy focuses on. So I think it was inevitable that there would have been an increase in that, and it was also quite widely trailed that there would be some sort of levy on the non-carbon energy producers. So and hence the introduction of the energy generation levy. Interestingly, though, wind farms and solar farms that benefit from the contracts for difference regime, which was introduced in 2014, aren't subject to that particular levy. If you actually look at the makeup, particularly of the offshore wind farm sector in the North Sea, the makeup of most of those generators is of multinational companies, not UK companies. So given that most of the green incentives feed through to our bills, and in this particular case, large multinationals, large non-UK multinationals are benefiting from not having an additional levy on their excess profits, one might question whether it's been properly targeted.
Absolutely, and with the kind of investment allowance for some of these large energy businesses dropping, but then bringing in a significant decarbonisation allowance, a lot of complexity there, and the rules will need to be worked through in quite a lot of detail. Next, a brief point on sort of increasing the minimum wage, which I think is really good for individuals that need that support. Not going to be slightly challenging from an inflationary perspective. Obviously really good for the government because that extra pay will result in additional payroll taxes, etc. But there's a lot of businesses who need support will be struggling with that point. Hopefully some of that challenge will be offset by the business rate support they're being offered as well. So finally, a recap on some of the other changes that were expected and confirmed yesterday. The annual investment allowance for capital expenditure staying at the £1 million level indefinitely is very good for investment. The corporate tax rate going up from 19 to 25% from next April. Obviously a significant additional cost for business, not great from a foreign direct investment perspective post-Brexit. So whether the full benefits are expected there will be seen by the government, we'll have to wait and see. And then finally, the more detailed new transfer pricing documentation requirements, all additional things for business to consider off the back of yesterday's announcements. Chris, any final comments?
Not really. I suppose just on the AIA, I think I'd like to have seen that probably increase to 10 million. I think there's an inflationary impact on investment in the UK. Clearly, as you invest, if you don't get a full deduction at the outset for your investment, then you never get full relief for it. So I think increasing the limit to 1 million is a good thing, but maybe the Chancellor could have gone a bit further on that point.
Thanks for listening. Have a good day.